Why Americans are drowning in debt. The growing debt crisis in the U.S. reflects a complex web of financial challenges impacting millions. From skyrocketing living expenses to systemic issues like inadequate financial education and economic inequality, these factors contribute to an overwhelming debt burden for many Americans. Addressing these root causes is crucial for finding sustainable solutions and improving financial well-being across the nation. Number 10. High cost of living. The high cost of living in many parts of the U.S. significantly contributes to rising debt levels. With expenses for housing, healthcare, and everyday necessities soaring, many Americans find themselves struggling to make ends meet. This constant pressure to cover basic living expenses often leads individuals to rely on credit cards and loans, further exacerbating their financial burdens. What if the relentless rise in living costs was pushing you further into debt? For many, the gap between income and expenditure is widening, creating a cycle where debt becomes a necessary tool for daily survival. Additionally, the cost of living often varies dramatically between regions, leading to disparities in financial strain and debt accumulation across the country. As wages fail to keep pace with inflation and living costs, the struggle to manage expenses without falling into debt becomes increasingly difficult. Number 9. Student loan debt. Student loan debt has become a major financial burden for millions of Americans. The rising costs of higher education and the substantial amounts borrowed for tuition have left many graduates with significant debt loads. This debt often takes years, if not decades, to repay, impacting borrowers' ability to save for retirement, purchase homes, or invest in other areas. What if your pursuit of education was leaving you with a lifetime of financial strain? The mounting student loan balances also come with high interest rates that increase the total amount repaid over time. Graduates may face difficulty finding high-paying jobs in their fields, making it challenging to manage or pay off these loans. Furthermore, the inability to discharge student loans through bankruptcy means that many are trapped in a cycle of repayment with little hope of relief, further compounding their financial struggles. Number 8. Credit card debt. Credit card debt is a prevalent issue for many Americans, driven by easy access to credit and high interest rates. Many people accumulate debt through everyday purchases, often falling into the trap of only making minimum payments. What if your daily spending was creating a mountain of high-interest debt? Credit card debt can quickly spiral out of control as the high interest rates and fees lead to compounding costs. The ease of obtaining credit cards and the temptation to use them for non-essential purchases contribute to this growing problem. Additionally, people often rely on credit cards during emergencies or financial shortfalls, which can further exacerbate their debt issues. The revolving nature of credit card balances means that paying off the principal is challenging, leading to a long-term debt cycle that is hard to break. Number 7. Medical expenses. Medical expenses in the U.S. are a significant contributor to personal debt, especially for those without comprehensive health insurance. Unexpected medical emergencies or ongoing treatment costs can lead to substantial debt. What if a sudden health crisis was derailing your financial stability? Even with insurance, high deductibles, copays, and out-of-pocket expenses can result in overwhelming bills. The financial strain of medical debt is exacerbated by the fact that many people do not have emergency savings to cover these costs. Additionally, medical debt can impact credit scores and limit future financial opportunities. The challenge of managing medical expenses is compounded by the complexity of billing and insurance claims, making it difficult for individuals to navigate their financial responsibilities in the face of health issues. Number 6. Housing costs. Rising housing costs, including both rent and mortgage payments, are a major factor in the increasing debt levels among Americans. The affordability crisis in housing markets has pushed many individuals and families to spend a disproportionate amount of their income on housing. What if your home was becoming a financial trap rather than a sanctuary? This strain on household budgets leaves less room for savings or investment, and making it difficult to weather financial setbacks. In many cases, people are forced to take on additional debt to cover housing costs, further entrenching their financial difficulties. The housing market's volatility can also impact home values and create uncertainty for homeowners. High housing costs, combined with stagnant wages, contribute to an environment where debt becomes an unavoidable part of financial management for many households. Number 5. Unemployment and underemployment. Job instability, unemployment, and underemployment are significant contributors to rising debt levels. Many Americans face periods of job loss or underemployment, which impacts their ability to meet financial obligations. What if job insecurity was pushing you further into debt? The inability to secure stable, well-paying employment often leads individuals to rely on credit to cover essential expenses. Even temporary job losses can result in long-term financial repercussions, as unemployment benefits are typically insufficient to fully cover living costs. The challenges of finding a new job or advancing in one's career can prolong financial hardship and increase reliance on borrowed funds. Additionally, Underemployment often means accepting lower wages or less hours, which exacerbates financial instability and debt accumulation. Number 4. Financial literacy gaps. A lack of financial literacy and education contributes to poor money management and increased debt. Many Americans are not equipped with the knowledge to effectively manage their finances, budget, or understand the implications of debt. What if your lack of financial knowledge was leading you into deeper debt? This gap in financial education often results in poor financial decisions, such as overusing credit, failing to save, or misunderstanding loan terms. Without proper financial education, individuals may struggle with budgeting, saving, and investing effectively. This lack of knowledge can lead to accumulating unnecessary debt and making financial choices that are not in their best long-term interest. Improving financial literacy through education and resources is essential for promoting better financial health and preventing debt accumulation. Number 3. Consumer culture and spending habits. The strong consumer culture in the U.S. encourages spending and materialism, often leading individuals to incur debt to maintain a certain lifestyle. The pressure to keep up with trends and societal expectations can result in excessive spending. What if societal pressures were driving you to spend beyond your means? This culture of consumption fosters a cycle of debt accumulation as people frequently purchase items they cannot afford to appear successful or affluent. The constant exposure to advertising and consumerism can make it challenging for individuals to prioritize saving and budgeting over spending. Additionally, the desire for instant gratification often overrides financial prudence, leading to increased debt levels. Addressing the impact of consumer culture is crucial for promoting more sustainable spending habits and reducing overall debt. Number 2. Poor savings rates. Many Americans have inadequate savings, leaving them vulnerable to financial shocks and leading them to rely on credit when unexpected expenses arise. Low savings rates make it difficult to manage emergencies or plan for the future. What if the lack of a financial safety net was forcing you into debt during times of crisis? The absence of sufficient savings means individuals are more likely to turn to credit cards or loans to cover unexpected costs, which can quickly escalate into significant debt. This lack of financial cushion also limits opportunities for investing and building wealth. Encouraging higher savings rates and creating emergency funds are essential for improving financial stability and reducing reliance on credit during times of need. Building a robust financial safety net can help individuals better manage financial shocks and avoid accumulating excessive debt. Number 1. Economic inequality. Economic inequality in the U.S. exacerbates the debt crisis as income disparities create barriers to financial stability for many. Those in lower income brackets often face higher costs of living and fewer opportunities to increase their earnings. What if economic inequality was driving you into debt despite your best efforts? The disparity in income and wealth accumulation means that those at the lower end of the economic spectrum are more likely to struggle with debt and financial insecurity. This inequality limits access to resources, opportunities, and financial education, making it harder for individuals to improve their financial situations. Addressing economic inequality requires comprehensive policy changes and targeted interventions to promote equitable economic growth and financial stability. Reducing income disparities and improving access to opportunities can help mitigate the impact of debt on vulnerable populations. Thank you for tuning in. If you enjoyed the content, please hit the like button and subscribe to stay updated with our latest videos on YouTube.